Ryan Detrick, how are you doing today?
Good morning, Jonathan. I'm doing well. As we were just talking about, we got some new stuff to talk about today. My oh my, it's a busy morning. Busy morning.
It is. So this is What the Wealth. I started a podcast earlier this year. You came on in March or April, and we talked about the markets in the economy. And I wanted to bring you back on and do kind of a live stream so that clients and people are just asking us a lot of questions about the market and the election and what's going to happen. And I thought no better way than to answer some of those questions and then get the master statistician himself on here. So thanks for coming.
No, this is my second time, right? I think I was your fourth or fifth person, I think. And I said, why did you not have me first? It broke my heart. But nonetheless, I'm honored to be back the second time. And boy, when was I on last time? Do you remember? I mean,
I think it was
time ago, but
late March or early April, possibly.
Yeah, so middle of right when COVID was getting bad. That's what I thought. So obviously markets are a lot higher and the economy is a lot better than then. But let's boy, we've still got some things to talk about.
Absolutely. So I guess before we get started too much, this is a live stream. I will record this and put it on the podcast that will air on the 15th. So for those that are listening to this 2 weeks in the future, then I just want to make a couple of disclosures. This is not investment advice. This is not any kind of guarantee. You should consult your financial advisor and your investment professionals with you. I do think that this will kind of help provide a lot of information for just people out there as there's questions. And so I think one of the first questions that kind of popped up overnight was the president and first lady both tested positive for COVID-19. And I woke up at around 4:00 to feed the new baby. And I looked at the futures. Futures were way down. And it just reminded me kind of how irrational this is. I know in the Bednar household, we're not spending less because the president got COVID. I mean, we're still ordering our dog food from Amazon. We still have to buy toothpaste and deodorant. We still have to buy groceries and pay the light bill. And so some of the kind of irrational behavior of the market is, well, just that. It's irrational noise. So, I'd like to hear kind of what your take is on what happened overnight with the positive test out of the White House for COVID-19 and the market's reaction.
Well, yeah, first off, from everyone at LPL and LPL Research, obviously our thoughts go out to President Trump and the First Lady. Let's hope that they can beat this and get back on the other side very, very quickly. But, I guess last night when I went to sleep, you heard, one of the president's main aides tested positive, and he sent out condolences and said that he had just been tested. So, we saw this kind of last night at least on the East Coast when we all went to sleep. Then we wake up to the news, obviously, that he officially tested positive along with the First Lady. So, what do markets hate, right? Markets hate uncertainty. And this is a level of uncertainty. There's no question about it. But the interesting thing is the calendar. You look at history, October, for whatever reason, October is a month full of surprises. And we always think October 29, 87, 2008, spectacular crashes. October has also had some really big gains. At the end of the day, October is like an average month. It's just the most volatile month. And this is an election year. We're going to talk about the election in a little bit. October during election year is the worst month of the year during an election year. That's some pre-skittishness, I guess you could say, ahead of the election. So it all makes sense. This is our October surprise. We figured there'd be one, and this is it. But you're right. I mean, the reality of the fact is the economy is still improving. Right. I mean, the stock market, as the time we're recording this, is well off the lows from where futures were last night. We're bouncing. But what caught me was when you look at the risk assets, things like gold, things like the yen, things like the 10-year yield. When futures were down several percent, a couple hours ago, those weren't really reacting. And you wonder, do they know something else that we don't know? Is the market just volatile? We've had a big run, right? Stocks up 60% in 6 months, almost since the last time we talked, I think you could say. You know, a 10% correction, 15% correction in the NASDAQ. This is just some more volatility. You know, we're not minimizing it because it's very, very big news. But at the same time, S&P is down about 0.5% as the time we do this. I mean, you know, we had the jobs number that came out. No one's even talking about that. That missed by a little bit. I'll put a bow on this so I let you ask the question. One of the potential positives from this could be that the next stimulus bill is that much closer, right? Whether it be to kind of change the perception of the narrative in the media or to get some good news. I mean, Disney just laid off 28,000 people. Airlines are laying off thousands and thousands of people. There are some really terrible things that are still happening in our country. Believe me, we think the recession's over. Parts of the economy are doing great. There are parts that are struggling. So with this news today, the chances we think of that next fiscal stimulus bill being completed, you know, sometime over the next couple of weeks, probably just increased, and that could be a positive, a real positive. Last thing, you know, President Trump's health. I mean, he gets tested every day. You know, he gets tested a lot. So you have to hope and pray that they caught this extremely early. Obviously, you have the best doctors and the best everything that you can have. There've been some other, you know, the prime minister in UK, the president in Brazil, other leaders have caught this and beaten it. You know, they caught it early and they beat it. So let's hope that he can follow in those footsteps as well.
I think you've provided a lot of great insight, especially around some of those risk assets and gold and the treasury, and not seeing the reaction kind of reiterates that what we've seen over the last, you know, 6, 7, 8 hours just in the market. And yeah, as I look now, Dow's, you know, well off the lows, rebounding up. And you and I talked briefly before we even started this. It wouldn't surprise either one of us if the market closes in the green today. So, you know, I think that, you know, it's easy to get kind of distracted by the noise of what's going on TV, and you got to kind of sit back and be able to digest, you know, what's really happening and what's going on.
Yeah, it's funny you mentioned TV. I was supposed to be on CNBC today at 7 o'clock. My wife's out of town juggling some kids and stuff, and I turned it down. Now they might have bumped me because sometimes something big happens, you get bumped. But my oh my, being on CNBC this morning at 7 o'clock could have been a pretty big deal. There'd have been a lot of eyeballs. But hey, you know, it is what it is. But I mean, you know, yeah, I mean, so let's talk about the economy for a second. I mean, the jobs number just came out. We're still making, you know, hundreds and thousands of jobs, and we had more jobs created the last couple of months as they upped that. So we still haven't made up the 20 million jobs we lost. We're fully aware of that. And this number missed by a little bit. And one thing you can say is a problem with the economy, I guess you could say, is you know, the stickiness of the initial claims. Still seeing, you know, close to 800,000 people a week filing for initial jobless claims, which is obviously a tragic number. But still, then you turn the page, you look at manufacturing. Manufacturing's really, really coming back. Some of those regional manufacturing, the Dallas Fed PMI and the Philly PMI and the New York PMI, all these different regional manufacturing numbers, like 2-year highs, huge moves. Then you look at housing, 14-year high in existing home sales, new home sales, pending home sales just hit a record. There are some pockets of really, really good strength. And at the end of the day, earnings are what drive the economy. That's the truth. And earnings last quarter weren't that great, but they were better than expected, way better than expected. And what corporate America had to say about the future was really positive also. So there's a reason the S&P 500 is just a couple percent from all-time high. NASDAQ a little more on the pullback, but it went up more. And that's because, you know, the stocks anticipate potentially a much stronger economy. And once we get a vaccine, which is kind of a win, not an if at this point, and major therapeutic breakthroughs again, this time next year, you know, whoever wins this election, we'll talk about the election soon, whoever wins this election is going to have the keys to a really good economy, in our view, an economy that is improving, expanding. And oh, by the way, the Fed is still there. The Fed is still extremely a tailwind, I guess I could say, with their policy that they are doing. So that's something you don't want to fight either.
Yeah, I think they've said they plan to stay very dovish, rates low for longer. I think I've even seen 2023, maybe 2024, and who knows? There's a lot of time between now and then. So, you know, could go on for a prolonged period of time. We may be talking about this a little bit later, but where do you? I think I saw a slide the other day, and again, we may talk about it in the elections, but I think you're expecting earnings, or LPL Research is expecting earnings to really skyrocket next year and come off some of the lows. So I think that's interesting. Maybe we could touch on that, you know, maybe right here.
Sure. Yeah, so I should be sharing it right now. Earnings expected to surge in 2021. U.S. earnings, we'll call it S&P 500, supposed to be up maybe 25%. Small cap earnings are supposed to be up close to 100%. Now, small caps are more domestic by nature. They've been really hit hard this year in terms of earnings and performance. But those are good steps, right? And on the screen shows, this is a global recession in 2020. We know that, right? I mean, every part of the globe did pretty poorly. But next year, you're seeing actually more earnings growth out of developed markets and emerging markets than you are in the U.S. I mean, so this is a global, global comeback, I guess we'll call it. And again, you think about what companies are saying about the future. There aren't that many earnings warnings. If FactSet keeps track of this stuff, they look at the number of earning warnings. There haven't been that many. Now, the catch to that, not that many companies are giving forward guidance either, because there is so much uncertainty out there. But I mean, when you come in, if you have 25% earnings growth, it's very, very rare you're going to have a recession. In fact, it's incredibly unlikely you're probably going to have a recession with that case. And again, it's an improving economy, and earnings drive things. So it's a global recovery, and one, again, that is something we wouldn't want to bet against. Think about recessions and expansions. We just had probably a 4 or 5 month recession. In our view at LPL Research, the recession is over. It's not officially over, but it's going to be officially over when they retroactively go into things. And the average expansion, Jonathan, is 5 years. Now, we're not saying there's going to be a 5-year expansion again. We just had a 10-year one. But to think that, this expansion is only a couple months old, it's just going to end right away is kind of foolish in our view. I mean, these expansions last a while. And then you look at the screen with that earnings growth that we're seeing in 2021, there could be a good amount of time left to this expansion and to this new, what I'm going to call it, new bull market, which was just born recently when we made new highs a couple months ago.
Great. I think that's great insight, helping with all of that. I think I think the big question that I'm getting a lot of, our office is getting a lot of, I know you're getting a lot of, and I've seen the information that you've put out through LPL Research, and that is how is the U.S. election going to affect the markets? And obviously we're not going to get into a political conversation here. It's not about blue versus red or red versus blue, but I think you've got a lot of really unique stats that most people just no one's thought of, and I think diving into some of these stats will really help kind of pave or shine some light on what we expect over the next 3, 6, 9, 12 months, and ultimately I think the market just gets really nervous about the uncertainty.
Right.
And so we're kind of in that conundrum right now. What happens over the next 30 days and 45 days? Once some of that certainty plays out, then I think the market's able to know how to react and what the outcomes will be, and can then start pricing back in what the next 4 years will look like. So in your mind, in LPL Research's mind, how do you think the U.S. election affects the stock market and investments?
Yeah, very quickly. I just want to talk on the screen just for a second. This is the final thing on the economy, then we'll get to that. This is jobs, right? How many jobs are lost? And you can see we just had a big drop in jobs lost. We know that with 20 million. All I think that's really important to note from this, it took 7 years for jobs to come back after the financial crisis and 4 years for jobs to come back after the recession of 2000, 2001. My point being, we're more of a developed country. We're kind of like a cruise ship turning around. It takes a while to get going anywhere. It's going to take a while. It might take years and years and years for all of these jobs to fully come back, and that's the sad truth. The recession's over in our view, but again, it might take a while to get there. Now, you talk about elections. I'm showing on the screen here kind of the calendar. This is what happens during an election year. Well, we're in the sweet spot for weakness. Okay, and that's normal. Again, October is the worst month of the year during an election year, and you tend to see a little bit of weakness here. But what's really unique about it, no matter who wins the election, you tend to get a rally at the end of the year. Okay, now that's not perfect, I'm aware. But once that uncertainty is resolved, you can see on the screen, November and December are usually pretty strong months. Now, one of the unique things about this year, in my opinion, was we have a split Congress, right? Now, we've had a split Congress in the past, and one of the interesting tidbits is when you have a split Congress, stocks tend to do well. On the screen we're showing, stocks are up the S&P at least, 17.2% on average under a split Congress. The best scenario. You could argue the best Washington is one that can't get anything done, right? Checks and balances, not too much power one way or the other. And our base case at LPL Research, this election is likely much closer than what the polls are telling us. And I'm going to share some charts why we think that in a second. But if it's much closer, we still think there's going to be a split Congress. So whoever wins this election in a month, which is a month and 1 day, right? A month and 1 day, we're going to. If you have a split Congress, which is our base case, that's still probably what you should be most excited about, I guess we could say, from an investments point of view. Now, I'll talk about the stock market for a second. We asked, can the stock market predict the president? What I'm showing on the screen is the answer is yes. 20 23 times the stock market's been right. And what do I mean by right? If the stocks are up 3 months before the election, the incumbent party wins. Stocks are down 3 months before the election, incumbent party loses. I mean, it's fairly simple, yet sometimes that works. So why is that? Well, if you have a change in leadership, a new party in power, there's a little bit of uncertainty, and maybe the market sells off ahead of that. If it's comfortable with the guy in charge, whether you like him or you don't, it knows what you're going to get. So you get strength. And this is what I'm showing on the screen. Was really interesting in 2016. Hillary Clinton, everyone thought she'd win, including LPL Research. She didn't. And copper had a 14-day win streak. The Dow had a 9-day losing streak directly ahead of the election. The markets weren't so sure what all the other economists and strategists and talking heads were saying. And that's why we're going to listen to Mr. Market. Now, since August 3rd, stocks are a little bit higher. We had that huge August, one of the best Augusts in years. Then we had one of the worst Septembers in years. But still, stocks are a little bit higher. And we think, if history holds true, if we get a surprise rally in October, again, remember I mentioned October tends to be weak in election year. You get a surprise October rally, that might be the market's way of telling us President Trump has a much more likely potential chance to win this election. And this is similar to what I just talked about, where I'm showing in the yellow. The blue is what happens when the incumbent party wins for the S&P, and the orange is what happens when they lose. So this is that sweet spot where this thing starts to diverge, the stock market. If the stock market starts doing well, that tends to bode well for President Trump. If stock market tends to be weak here, it bodes well for Vice President Biden to win the election. So we're still in that sweet spot, obviously. Let's go skip that one. Let's see here. Now, we'll talk about that. Okay, so the dollar. We'll talk about the dollar for a second. So you think about the U.S. dollar. It's kind of a risk-on, risk-off trade by itself, right? At the end of the day, if the dollar is strong, like we saw back in March, remember what happened in March? Stocks got killed, bonds got killed, gold got killed. Dollar didn't. Dollar went up, okay? Then lately, when things got better, dollar was weak. So our base case at LPL Research is for a little bit weaker dollar. We think there's some structural reasons to think there's going to be a weaker dollar. But directly ahead of the election, how the dollar is doing matters. And again, this is the opposite, actually. If the dollar is higher, that tends to mean the incumbent president is going to lose. If the dollar is weaker, that means the incumbent president is going to win. It means, again, weaker dollar, things are more normal. A strong dollar, things are kind of skittish. And you can see on the screen, it's worked 5 out of 6 times recently. So again, the dollar recently has been a little strong, actually. It's a little higher now. I haven't updated this. It's a little higher on the weakness we just had. So that potentially would suggest Joe Biden. But the last thing I want to talk about is the economy. When you have a recession ahead of an election, which is this screen right here, they're election killers. Okay, we've had 4 recessions going back to the Great Depression. Every single time I'm sorry, I should rephrase that. If you look 2 years before an election, we've had 4 recessions that were right ahead of an election. The incumbent president lost every single time. Okay. Now, what's unique about this, though, is if you don't have a recession, the incumbent incoming president wins. But look at 1924. Calvin Coolidge won the election ahead with a recession ahead of that. That was the Roaring 20s. So we had a recession. Then the economy really started to improve, and people voted in Calvin Coolidge again. And you think about now, clearly we had a vicious recession, and there are parts of the economy that are still devastated by it. But there are other parts that are really coming back. So we're going to have a GDP number, forget the exact day, October 28th or 29th, sometime around then, that might be, according to the Atlanta Now Fed, 35% growth in the third quarter. So that's like all-time record. Now, we lost 31% the quarter before, one of the worst ever. But still, the economy is churning higher without question and improving, and that potentially can benefit President Trump. But if the economic data weakens a little bit here, we have more outbreaks the next couple of months, more rolling shutdowns, or not a couple of months, next month is what I should say, that could impact the election as well. So there's all these different scenarios. It's really, really interesting. But that's kind of my high level walkthrough of the election and kind of what we see. And we can talk a little more election, economy, whatever you want. But I'll bring you back in here, Jonathan.
So yeah, I think you pointed out we've got some stats that could point really in both parties' way, and we're still kind of in the undecided. It is amazing that the closer we get to election, some of these stats that you've gone through and shown have been really pretty accurate on predicting who wins. And kind of mirror what we see in the polling. And I think we're still a little bit far from that, 30 days out or so. But it is just kind of ironic to go through and see some of these stats and see how right the predictors end up being. I didn't pull a slide for this, but there's a mutual fund company out there. I probably can't mention them just to make sure that I stay within compliance. But
let's not get in trouble.
They've done a really good job going back over the last 5, 6, 7 presidents, or 4 or 5 presidents, whatever it is, and show that really there's been growth no matter what party's there. And so a lot of the conversations I have are around, well, if so-and-so wins, this is going to happen and it's going to tank the market. Or if so-and-so wins, they're going to do this and that's bad for X, Y, Z reasons. And a lot of what the president and the Congress and Senate does, I don't want to discredit saying that it doesn't have an impact on the market and the economy, because it obviously does. But I think what drives companies, and correct me if I'm wrong, but what drives companies' growth is their earnings. And that's where I go back to at the beginning of the conversation. We were talking about, President Trump getting diagnosed with COVID-19, markets selling off, and we are continuing to climb almost into positive territory as we speak now. But I just don't know that spending habits change overnight. And I think there's still a lot of pent-up demand for travel. You're seeing people get more comfortable traveling. You're seeing people that maybe they couldn't take the vacation they had planned this year, so they went and bought a new Sea-Doo, or they went and bought an RV camper. And so I think there's still a lot of pent-up demand in this market. And ultimately that demand gets put into companies' earnings because people are spending money. Earnings drive share price. And so what you see is over the last 4, 5, 6 presidents, that when you start going 12 months later, 18 months later, 2 years later after the election, it really doesn't matter if it's a Republican office or Democrat in office. The market gets back to the fundamentals, and the fundamentals are earnings driving share price. And if there's earnings and people are spending money, and we're a consumption-based economy here in the United States, then you see, in a longer-term aspect of investing, that lift all boats, and asset prices in the stock market, usually goes higher.
Yeah, I mean, excellent points there, Jonathan. You think about in 2008 when President Obama won. There are a lot of people who didn't agree with his policies, and they said, you know what, I'm not going to invest in the stock market. Don't trust him. Don't like what he's doing. I'm going to buy gold. Well, that didn't work so well. There was a huge rally for 8 years. President Trump, similar, last 4 years. A lot of people don't like President Trump, and they probably missed some enormous gains. Since President Trump's been president, we've had nearly 150 new all-time highs in the S&P 500. So we like to say this, politics and your investments really don't mix. I mean, our brains work in opposite ways sometimes, and they can confuse us. So again, whoever wins this election, like I stressed, is really getting a good economy. Now we would really focus on the economy a lot more here. And should there be a split Congress, that tends to be a positive. But just think about this: when in 2016, when we had the red, I guess what do you call it, red wave? I guess with the Republicans taking both chambers of the House and the presidency, the S&P went up 15 straight months. Okay, things did okay there, even when there was full power there, because one of the concerns we hear about, or at least comments we get, is what if there's a blue wave? What if there's higher taxes? Well, you look back in history, stock markets have done really well, actually, when you had what we call the blue wave, both chambers of Congress and a Democrat in the White House. And again, a lot of those years were pretty good economic years. So how the economy is doing truly matters more for your investments. And I get, we want LPL, we want people to have a voice. We obviously want people to vote and get out there and make change. But there's a fine line here, because sometimes if you really don't like the guy in office, You don't want to invest in the stock market. And that is, we saw for 8 years under President Obama, and for the last 4 years under President Trump, there have been some huge gains that are out there. Now, just very quickly, like, I hate to do this because everyone's like, what does well? Remember, so under Biden, potentially infrastructure bill. Okay, there's likely more infrastructure bill could be passed. With all the spending going on, we think it's going to be a little harder if the Republicans are in power, as they might not want to have the same size of infrastructure bill. Cyclicals historically do better when you have a Democratic president and when the incumbent party loses. So that's something to be aware of. Clearly, renewable energy, immigration, marijuana legislation, and guns. Guns, well, those first three, they're kind of more obvious. Trade, less issues with China. Immigration reform and renewable energy, we know that. Now, guns is an interesting one because there's more regulation, but it actually means people are going to buy more guns. So it's kind of just something to be aware of. Now, under President Trump, actually, let me open this up. Sorry, I did a different screen. Give me 1 second. There we go. That should have moved. There we go. Under President Trump, energy should do a little bit better. So should financials. Less deregulation. Let's be honest, though. The last 4 years, those groups haven't done that well. But still, those are more tailwinds, we think, than if not. Aerospace, defense should do better. You can flip some of these, obviously. Shouldn't do as well under Joe Biden in those cases. With the tax hikes, utilities, communication services, financials, and CD, consumer discretionary, all could be hurt a little bit more with the potential 28% corporate tax rate by Joe Biden. For-profit prisons and for-profit education, both should be a little more of a tailwind under President Trump. And technology is the big one. Tech's done great under President Trump, so you could say maybe it'll do good under him again for another 4 years because Democrats might have more regulation against technology. Now, I want to put a bow on this because I just listed all this stuff and hammer through the but. When President Trump won in 2016, everyone said this: coal and steel and banks would do awesome. Technology would struggle because he's going to go after big cap tech. Pretty much the exact opposite thing has happened. So if everyone's talking about it, sometimes it's not so obvious. We all want to know what happens. I think it's just so important, for you and your clients listen to you, keep a well-diversified portfolio. Don't just pick a certain sector and sit in it. Do a well-diversified portfolio. Use some bonds. You use some stocks. I mean, at LPL Research, we do think stocks will outperform bonds over the next 12 to 18 months. But I'm not saying don't have any bonds because what we saw back in March, stocks went down a lot. Bonds actually struggled too, but they didn't go down as much. They helped you, and then they bounced back. So it makes sense to take a bigger picture view, not get too cute in a lot of this. Well, if he wins, this is going to happen. It didn't happen in 2016, and it probably won't happen again because if everybody's talking about it, Mr. Market has it priced in, and it might not be so obvious. And that's just kind of I want to make sure that's I think it's an important point. I know you talk with your clients about that every day.
I think you've actually hit the nail on the head, and maybe a great way to just kind of close us out right there. Actually, is that the point of this is to not try to make your investment decisions based on the next 30 days or 3 months, or trying to time some certain sector over another sector or some strategy over another strategy. It's to kind of stay the course, follow your investment policy statement, have a plan, and as times get emotional, and it's hard to just strip out emotions out of investing. It's actually, I would argue, virtually impossible.
Yep.
But that's why having a trusted resource, someone you can talk with, really can help provide a lot of comfort in what's going on. I call it head trash. I get it myself, and I get zoned in thinking that this is a way I should do something, or this is something we should invest in, or even in my personal life, here's something we should do. And a lot of times it's just good to go and consult mentors or advisors or people that are on your side that can give you advice from a third party, unbiased in point of view. And unbiased is kind of, I got to be careful about how I say that, because I don't know that you can ever be totally unbiased about anything. But what I mean is when it's your situation, then you're much more emotional than if it's someone else's situation. And so usually some of that confidence that you can find and talk through with somebody will kind of help alleviate some of those emotional decisions that are easy to make, especially in election years. We see these questions come up all the time, even in non-election years. But I think it's
right.
It's like a 10x when you start having an election year, because it's just talking about parties flipping and who's going to control what and what the impacts are going to be. And at the end of the day, we need to be thinking about long term. And it doesn't have to be 30, 40, 50 years. A lot of clients say that all the time. I don't have 30 or 40 or 50 years. We're still making decisions for 1 year down the road, 3 years down the road, 5 years down the road. And I think trying to keep emotions in check with a diversified portfolio, with an investment policy statement that kind of helps guide the decision making, are two ways to kind of have some combat against the emotional biases that can potentially have a negative impact on your portfolio.
Nothing you said I would disagree with. That was awesome. I mean, obviously, I'm honored to be here on What the Wealth for the second time, and I'm so happy for everything you're doing for the Paradigm clients, and hopefully some of your future clients that see this, and just the way you're communicating with me, using different ways to get your views and your opinions out there are just awesome. I say it's the Wayne Gretzky quote. We've all heard it. I think you can't do a presentation without it. But skate to where the puck is going to be, not to where the puck is. And just this form of communication and the way that you're doing things for your clients is awesome. And I'm just glad that LPL Research is a small part of it. And I'm just a phone call or text away if you ever need anything from me. And just thanks, man, for having me. And I guess we'll do the next one in 2021. Doesn't that feel weird? I don't know, 2021. That's weird, but I look forward to being to a new year. Let's put it that way.
It does. I think we all do. I appreciate you coming on to What the Wealth. I appreciate you. You are the first guest on the live stream. So you feel honored. And again, I appreciate your time, your insights, taking some time out of your day. I know that you got some family that you're gonna go spend some time with today and over the weekend. So thanks for coming on, and we look forward to doing this again maybe next year, and doing it again.
Absolutely. Thank you.
All right. Thanks, Ryan.